Bismillahirrahmanirrahim. Welcome everyone to today's session with the topic Introduction to Financial Statements. Let me first welcome Professor Mohammed Abrar Hussain, the head of Discipline, Accounting and Finance at AFG College with the University of Aberdeen. And please let me take this opportunity to express my genuine thanks and gratitude to the AFG College with the University of Aberdeen for their continued support in all our education programs. I would like to thank Mr. Abrar, and also I would like to thank Mr. Brian Buckley, the principal of the college. Today, I will give the floor to Mr. Mohammed Abrar to start the presentation for like 50 minutes. And then after that, we will have like 20 to 25 minutes question and answer session. After the webinar, you will receive a link of a survey. So please take a moment to fill out the survey, as this will help us always to know our performance and try to improve our performance in the webinars. If you have a question, I would highly appreciate it if you can put it in the Q&A section, not on the chats, because in the Q&A section, it's easier for us to track your questions and answer as much as we can at the end of our webinars today. Now, I will give the floor to Mr. Mohammed Abrar, the head of Discipline, Accounting and Finance at AFG College with the University of Aberdeen, to start the presentation. Please go ahead, Mr. Mohammed.
Hello and assalamu alaikum, everyone. It's my pleasure to be here, and I must start with expressing my thanks and gratitude to the management of the Qatar Stock Exchange and to Mr. Samer as well. And we look forward to continued support and collaboration between AFG College with the University of Aberdeen and Qatar Stock Exchange. Now, without any delay, let me come to the topic of the day, which is Introduction to Financial Statements. Now, of course, it's a very vast topic, and it's really a challenge to basically give a lot of information and explain important concepts during this short period of time, okay? And of course, this webinar will be followed up with subsequent webinars, hopefully as well, which will explain the topic further, because it's quite a vast and big topic. Now, first of all, before we go to financial statements, we have to see what exactly is meant by accounting. What is accounting? So basically, in simple terms, accounting is recording and classifying all the transactions with a commercial essence. The American Accounting Association gave a definition which says the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by the users of that information. Now you have to see that the information is recorded, classified, measured, and communicated for some purpose, okay, for some specific users. So it's not just collecting, recording, classifying, and measuring the information, but it has to have a purpose. And ultimately, it's the goals of the users, it's the requirements of the users to which all this accounting is aligned with. Now, of course, it is accounting is benchmarked by, it's overseen by, it has accounting principles, and of course it has legal implications as well. It is monitored by statutory requirements as well, and of course accounting standards. So accounting standards is a detailed set of rules and guidance, principles, frameworks. So there are two main popular frameworks, which is International Financial Reporting Standards and in US generally accepted accounting principles. Okay, and IOFIs are for Islamic banking and finance, Islamic accounting. But primarily in Qatar, you will see that IFRS is the statutory accounting framework, unless there is any specific separately identified framework. So first thing which you have to see is that under which framework the financial statements or the accounting has been done. Then what's important is how to understand, manage, and interpretation of financial information. Because if you can't understand, if you can't manage, and if you can't do an interpretation, then what's the use of that information, right? So that's why we have this series of webinars. And then another definition can be a service provided for those who need information about an entity's financial performance of its assets and liabilities. Now, of course, I will explain assets and liabilities soon. Accounting is not a very simple subject. It has many branches. It has evolved over a long period of time, right? You often hear financial accounting, which is financial reporting, cost and management accounting, financial management, corporate finance, taxation or statutory accounting, audits, external, internal, or government audits, bankruptcy and liquidation. All these have emerged and evolved from accounting, and all of these have different purposes. They fulfill different needs of different stakeholders, different users. So financial reporting, most common, what does it do? Provides information on making investment and credit decisions, assessing future cash flows, identifying future economic resources, assets, claims on resources, which are liabilities, changes in resources and claims, and then the recording, reporting, and interpreting of financial information for shareholders, investors, regulators, and there are, of course, several other stakeholders. Income statement, statement of financial position, and statement of cash flows. Of course, these are some of the reports which are generated as part of financial reporting. Management accounting has different objectives. It provides information to assist management of an organization or a company in making effective decisions and in helping control and direct the organizations. Basically, management accounting purposes in effective and efficient utilization of resources to achieve the objectives of the organization. It also helps planning its activities, business activities, of course, cost control, budgetary control, inventory control, product or service costing, pricing of the products or the services, how much should we sell it for, contribution break-even analysis, when we will achieve the break-even, and after what time we will start making profit, product profitability, performance evaluation, cash budgets, costing, product planning, and department reports, of course. So again, management objective is internal to the organization. Financial reporting objective is primarily external to the organization. Now, the big question, what are the financial statements? Why do we need the financial statements, right? And who uses those financial statements? What is the requirement for the financial statements? Why it is so important? So annual financial reports, of course, all the companies, especially the companies which are listed on any stock market, like if you go to the website of Qatar Stock Exchange, you will see that all the companies, they issue their annual reports. These are annual reports, not just the annual financial statements, but the annual reports. Companies must, by law, publish their annual reports and accounts. These are large documents. These have a lot of information. Financial statements and the auditor's report are part of those annual reports. These are also available on any company's website. For example, Qatar National Cement Company is a publicly listed company in Qatar. The 2020 year-end financial statements are found at this link, and we will look at these financial statements at the end. Okay, I'll take you through quickly on the financial statements of QNCC, the latest financial statements, the contents, of course, financial highlights, right? What are the ups and downs? Directors and chairpersons reports, management discussion and analysis, what are their achievements and what are the challenges and what are the plans for the futures. Income statement, also known as profit and loss account. Statement of financial position, also called balance sheet. Cash flow statements, right? Statement of changes in shareholders' equity, auditor's report, and most importantly, notes to the financial statements, which disclose accounting policies which have been adopted. So basically, I can tell you that there are 4 primary financial statements. You can see here there are 5 constituents here. but I will explain to you in a short while. But there are four primary financial statements: statement of financial position, balance sheet, statement of income or profit and loss account, right? Uh, Statement of changes in shareholders' equity, and cash flow statements. Now, all these four financial statements are incomplete. These are incomplete if not accompanied by the disclosures, which is integral part of the financial statements, also called notes to the financial statements. And we will talk about notes to the financial statements in detail uh, today. Okay, so what's the usefulness of financial statements and what are their limitations? Well, financial statements are extremely useful when you are making an investment decisions in any company. When you want to buy stocks of any company, of course, one of the first things you would look at is the financial statements. But you should be able to understand and make sense of those financial statements. But do the numbers in the balance sheet and in the income statement, are these sufficient to convey the performance of the organization you are considering for investment? Of course not, unless you go through the disclosures, unless you go through the notes to the financial statements, that what lies behind these numbers, what is the quality of the earnings, what are the accounting policies used, what are the accounting methods used, right? What are the contingencies, what are the risks and opportunities, okay? What are any contractual obligations? So of course all these are explained and are listed in the notes to the financial statements. Financial statements are, of course, extremely useful. These reflect the profitability and growth of a company, of an organization over a period of time. You can look at the financial statements for the last 5 years, for the last 10 years. These are extremely good for any financial analysis. They help user in prediction of future cash flows and future profitability. Remember, financial statements are prepared based on historical numbers, past performance. Past performance is not a guarantee for future profitability, for future performance, but it serves as a guideline for future performance. You can compute rate of returns, return on investment, right? You can evaluate the capital structure, the leverage, the risk. You can assess its liquidity and financial flexibility. What is the liquidity of the company? Is the company strong enough, and is it solvent? Can it generate? Can it get more loans? Can it issue more bonds? Right? And you can compare the performance with its competitors. You can compare the performance of the company with the industry averages. But of course, there are limitations as well. Financial statements, the numbers in the financial statements, results are affected by the accounting method used. Of course, it depends what method of depreciation you use, what method of valuation for inventories do you use, how do you use the fair value method. So how often do you revalue your assets? All these things affect the numbers in the income statement and the balance sheet. And of course, that's why it's all the more important to read the details in the notes to the financial statements. It does not reflect the current values because again, these are based on historical performance, historical numbers. And again, there are a lot of judgments and a lot of estimates which are used. Okay. It might omit some items of financial value. Okay, so again, these have certain limitations as well. Then we look at who are the users, primary users of the financial statements, external as well as internal users. Prospective investors, lenders, banks, to whom the company goes for asking for any credit facilities, any loan, any borrowings, creditors from whom company wants to get some trade creditors, suppliers, covenant compliance for loan covenants, suppliers, customers, financial analysts, right? Regulatory agencies, governments, external auditors, and then of course internally, board of directors, shareholders, senior management, employees, unions, as well as internal audit. Now you see all of these, whether external or internal, have some sort of stake in the company. Okay, so you can see here the financial statements have to have certain qualitative characteristics as well. Okay, those qualitative characteristics are basically fundamental. First of all, relevance. Okay, it should have the relevant data. Okay, it should be relevant. It should not have any irrelevant data. Faithful representation means that it should be based on facts. It should not be based on lots of assumptions, but it should reflect factual performance. Okay, it should enhance the value. It should be comparable. The financial statements should be comparable. Should be the accounting methods, the accounting principles, the valuation methods should be consistently applied. That's why you will see that the financial statements of any company, when you look at it, it has more than 1 years of comparative numbers always, and should be verifiability. That if somebody, the auditors, the regulators, the internal auditors, external auditors, if they want to verify the financial statements, of course, there is a audit trail available, readily available behind that. So these are prepared based on set of books of accounts. Timeliness, very, very important. Of course, you want critical information to be available in a very timely manner. Now, for example, December 2020 financial statements for the year ended December 31st, 2020 have already been issued for almost all the companies. But how would you feel if a company issues its December 31st, 2018 financial statements now? Those numbers are quite old. A lot of things have changed since then, right? So financial statements have to be issued in a timely manner on, of course, understandability. And these application of the IFRS or US GAAP, the financial reporting frameworks, they make these financial statements understandable, okay, based on certain guidelines and certain principles which are consistently applied. And then, of course, there are some basic assumptions, concepts, which are entity concept, that a company, an organization is a separate entity in itself, separate from its owners, separate from its shareholders. And it's a going concern assumption as well, that the company will continue its business in the foreseeable future without any risk of insolvency. Periodicity, the financial statements reflect its performance over a certain specific period of time. The annual financial statements, the audited financial statements are usually prepared on an annual basis, which is a financial year, calendar year, usually from January 1st to December 31st. Now, the income statement, the balance sheet, or the statement of cash flow, this income statement, statement of cash flows, and statement of changes in shareholders' equity are for the period, right? But balance sheet is as of certain specific date. It's a snapshot of financial position of a company, and we will discuss that in a more detail. There are certain basic principles which you must be aware of. First of all is the historical cost principles, that all the numbers which are mentioned in the financial statements, included in the financial statements, are based on the historical cost actually incurred. Okay, for example, these are not adjusted for the current inflation prices or current prices, current costs, or current exchange rates. Okay, transactions which are incurred, purchases or supplies, whatever you have spent, based on actual cost incurred, actual exchange rates are recorded. There are revenue recognition principles, okay, which is under IFRS 15. So revenue is recognized when it is realized or realizable, which means that you're certain that you will collect that revenue. And then matching principle. Of course, you match the costs incurred to the period in which you will generate the revenue. If you have incurred a cost today, but you will generate the benefit of use of those costs in next period, then you will not record those costs in your income statement in this period, but you will defer it, you will postpone it. Okay, and then of course, full disclosure principle, that you will disclose all the aspects of the transaction. Okay, that's why, again, this will be in the notes to the financial statements. So certain important concepts and categories which you need to understand. Of course, what are assets? Assets are what is controlled, often owned. These are the resources which are used to generate revenue, and these will create future benefit. What are liabilities? Liabilities in simple terms are obligations of the business. What is owed to third parties, not to capital providers. Okay, these are debts, obligations. Capital or equity, investments from shareholders or owners, and what is owed to the owners or shareholders of the company. Income is the sales and revenue from goods sold or services provided. Expenses are basically cost of day-to-day operations of the business. Okay, so what you spend, the money which you spend to buy assets, is not immediately expensed. Okay, so a simple example: income statement, is just like a history book or a movie of what has happened with income and expenses in the current period. Okay, it shows events for the whole year. It keeps records of everything from the first month of the year to the last month of the year. Whereas statement of financial position, the balance sheet is a snapshot, is like a picture, photograph of the current financial position. So the two sides must always balance. Debit should always be equal to credit. So balance sheet does not record the history of the full year. It reports the financial position at a specific point in time, just like your bank account. How much is your bank balance as of December 31st, 2020? Okay, so balance sheet is a snapshot of an entity's financial condition at a point in time. It reflects the financial situation of a company on a given day. Is a statement listing the total assets, what the company owns, and the liabilities, what the company owes to others, to third parties, and owner's equity, the real owners, the shareholders, indicating the net worth of a company at a certain point in time. Assets and liabilities are also shown in further subsets as current and non-current, and we will look at the examples of some of these. So there is a famous equation called accounting equation, okay, where assets or total assets are equal to liabilities plus tangible net worth, which is the shareholders' equity. Balance sheets are usually formatted in one of two ways. The first is the account format that lists assets on the left and liabilities and owner's equity on the right side, and the second is the statement format. Here is typical example of a balance sheet. Assets divided into main two categories: current assets, which will include cash and cash equivalents. So when we say cash equivalents, this includes all of your bank accounts, short-term deposits, any short-term investments which you would realize within the 90 days of their original purchase, like short-term treasury certificates, treasury bills, certificates of deposits with a maturity period of 90 days, and then marketable securities, inventories, or prepayments. These are all generally classified as current assets. Non-current assets would include your property, plant, and equipment, often called as fixed assets, your long-term investments, investments in associates, affiliates, okay, subsidiaries, any financial assets at fair value, any intangible assets, okay, like trademarks, patents, and any other assets. Then in liabilities and owner's equity, you can see current liabilities would generally include accounts payables, payables to the employees, bank loans, interest, which are due or within 1 year, accrued liabilities. Okay, accrued liabilities are those liabilities for which you have already obtained the benefit, but you have not yet paid the payment. Okay, long-term liabilities, long-term borrowings, long-term bank loans, any bonds payables, and any other liabilities. Now, basically a simple criteria for classifying between current and non-current or long-term is whatever assets you have the intention and ability to liquidate or realize within next 1 year is generally classified as current assets. And current liabilities are those liabilities, those obligations which you would have to pay during next 1 year of the balance sheet date. Owner's equity would generally include share capital, additional paid-in capital, any legal reserves, and retained earnings. And we will talk about owner's equity in detail shortly. So the basic accounting equation: assets is equal to liabilities plus stockholders' equity. So assets are the economic resources which are owned by a business. Liabilities are the financial obligations or debts of a business, and the owner's claim on the assets of a business, which is basically owner's equity. So the crucial question here is, how has the money entrusted to manage has been used? Where has the money come from and where it is now? It shows the financial position of a company at a given point in time, a snapshot, a photograph, right? So you can see here, assets is equal to liabilities plus capital, and if we expand it further, assets plus expenses equals liabilities plus capital plus income, or assets is equal to liabilities plus capital plus income minus expenses, right? So on the left side, assets and liabilities plus capital is the statement of financial position, and income minus expenses is your income statement. So the basic accounting equation can also be rewritten in this manner. Now, after the balance sheet, let's look at income statement, often called profit and loss account as well. So it's basically a comprehensible representation of profit and loss account. And put it simply, how much did you sell? What is your sales revenue? Your revenue generated by a business by all different major resources, the main activities of the company, the main business activities of the company. It shows all income and expenses over a period, the cost of sales, the cost which you incurred to generate your main revenue. So at the end of the period, all income and expenses are transferred to the income, profit and loss account. Structure, you will see that it's classified into operating and non-operating sections. Operating section includes gross revenues, direct expenditure, selling general and administrative expenses, financial and related charges. And non-operating section includes revenue as well as expenses that are non-routine in nature as part of this section. So what is non-routine in nature? Which can be like, for example, if you have rented out a small portion of your office, that is not your main business. If you have basically sold the grass on the lawn outside your factory, that's not your main business, right? So what do? You determine the expenses used up to obtain the revenue is referred as matching expenses against revenues. So basically you are matching the benefit obtained against the costs, okay? The revenue generated against the costs. So accrued expenses is the benefit has been received, but which has not been paid by the end of the period. For example, your utilities, electricity and water. You have used the electricity and water for the entire month, but you have not yet paid the bill. So the business will record the cost as an accrued expense. It's not a cash expense, it's an accrued expense. You have recorded a liability because if you have used, you have obtained the benefit of use of electricity and water. And then opposite to this is prepayment. Sometimes you prepay, you pay in advance. You haven't yet obtained the benefit, but you have already made the payment. The expense that has been paid in advance, the benefits from which will be received in next period. For example, sometimes companies could prepay the rent of their office or factory or warehouse in advance for 3 months or 6 months. So that is prepayment. So a quick format of the income statement or profit and loss. You start with net sale of goods, rendering of services, rental income, all these different revenues generated, and the cost of sales which have been incurred in generating these revenues, the direct costs. This includes generally cost of raw material, cost of direct labor, cost of factory overheads, all the direct costs. And then of course you generate gross profit, then selling and distribution expenses, administrative expenses, depreciation and amortization, other operating expenses or income. So depreciation and amortization, here is the thing. You need to, when I talked about fixed assets, property, plant and equipment, when you buy property, plant or equipment, or when you buy automobiles, you pay cash now, but you will be obtaining the benefit of the use of that plant or automobile for next several years, right? So you are basically now through depreciation and amortization, you are matching the benefit obtained with the cost incurred. Even though you have paid the cash in year one, but you are recognizing the expense against as and when you obtain the benefit of the use. So that's depreciation and amortization. Then of course, any financing costs, any finance income, share of profits of associates, and income tax and profit from the year from continuing operations. If you have any discontinued operations, you would generally show it separately for sake of information, more transparent information, profit and loss after tax from discontinued operations, and then at the bottom, net profit for the year. So basically, the next statement which we have, and that's very, very important, okay? Statement of cash flows. So statement of cash flows is very important. People might question that, okay, why we have, when we have statement of income or profit and loss accounts, why do we need statement of cash flows? Well, here is the thing. There's a famous saying called cash is king, right? The cash works as, or the working capital works as the lubricant works for the machinery. Same way cash works for the businesses. You need cash to pay off your obligations, to pay to your suppliers, to pay to your rent of your building, lease expenses, to pay salaries to your employees. Now, you may be a very profitable company, but what if you don't have sufficient cash when your invoices are due for payment, right? So statement of cash flow will help you. It shows the actual movements of cash in a given period in time. How did you generate cash? From which sources did you generate cash? What is your liquidity situation? How is your solvency position? Okay, how much financial flexibility do you have? It provides aggregate data of all cash inflows from both its ongoing operations and external investment financing sources, and cash outflows that pay for business activities and investments during a given period in time. So the statement of cash flows is divided basically into three components: operating activities, investing activities, and financing activities. So basically all the operating activities are classified together, all cash inflows and cash outflows. And it is extremely important that the businesses, solvent businesses, to maintain their liquidity, they generate cash flows from their operating activities. The cash flows from investing activities for an expanding company during expansion phase is likely to be negative, because you will be investing in your property, plant and equipment, in your fixed assets, buildings, machinery. So you'll be spending a lot. But if you are generating cash flows from investing activities, that is a dangerous trend, because that means that you are actually selling, you're disposing of assets to generate cash. And financing activities is basically what you borrow or what you generate from your shareholders, and the interest which you pay, or any payments which you make for loan installments or redemption of bonds. There are two main methods of preparing of statement of cash flows: direct and indirect. So basically one is more detailed, the other is fairly simple and straightforward. So you can see here a quick snapshot of statement of cash flows. Start with operating activities, you take profit before tax, you make certain adjustments. First adjustment which you make are the non-cash items, which is like depreciation and amortizations, right? Because you're preparing a statement of cash flow and you're matching it with reconciling it with your income statement. So now you have to adjust all the non-cash items. So major non-cash items and are depreciation and amortizations, or gain or losses on disposal of assets. So because in the investment section, you will be recording the actual proceeds from sale or disposal of your assets. And then of course, changes in working capital, which is increase or decrease in your accounts receivable or accounts payables or inventory, or movements in provisions, any interest paid, interest received, any income taxes paid. And then the next category is investing activities. It comprises proceeds from sale of property, plant and equipment, any financial instruments which you may have issued, purchase of property, plant and equipment, investment property, any financial instruments which you may have redeemed, and then financing activities, which is proceeds or repayment of borrowings, bank loans, bonds, etc. Any issue of shares or any dividend paid by the company. So here is a key. It's very easy to figure out. When an asset increases, other than cash, any asset increases, when your PP&E increases, if your accounts receivable increase, if your inventory increase, it means that you have spent cash. So your cash account will decrease. But if your asset decreases, if your PP&E decreases, if your receivables decrease, if your inventory decreases, it means your cash has increased. Your cash balance will increase, which means you have collected cash. So when your accounts receivable, when your trade receivables decrease, it means you have collected cash from your receivables. On the contrary, when a liability decreases, the cash account decreases, which means that if your loan balance decreases, if your accounts payables decrease, it means you have paid them. So your cash balance will decrease. But when a liability increases, it's the opposite. It means your cash balance will increase. It means you did not pay your liability. So if your accounts payables increase, or if your loan balance increases, it means that you have not paid, or you have collected, you have received cash from your borrowing. So, and when owner's equity increases, the cash account increases. When owner's equity decreases, the cash account decreases. So this is in simple terms, easy to understand. So statement of changes in owner's equity. This shows how the net worth, value or equity of business changed for the period from the previous period, from 2019 to 2020 or 2020 to 21, how the owner's equity, how the shareholders account has changed, and what are the major movements in that. So, for example, how much profit company has retained, how much dividend has been paid, okay, any new shares have been issued, any shares been redeemed. So it shows a linkage between the balance sheet and the income statement of a company, usually separated into two sections. Changes that affect the company's share capital and changes that affect the company's retained earnings. So retained earnings are the amount of profit which is retained since the company started cumulative, okay? So, which means that, of course, any dividends which are paid out of the profit or out of the retained earnings are deducted from here. Includes undistributed portion of net income or net loss, the effect of changes in accounting policies, the effect of retrospective or past changes, correction of any errors, additional money invested by owners, or any dividends paid. Now, some of these terminologies are like a bit heavy. They need a little more explanation because these relate to changes in accounting principles or changes in accounting methods or correction of errors, which are again, there are guidelines for those, detailed guidelines, but right now this is not in the scope of our discussion today. So we'll have this discussion sometimes later. So this is a quick snapshot of the Qatar National Cement Company's statement of changes in equity. So as you can see here, it has a lot of sections, but basically it provides you a snapshot of all the details of all the changes under different categories during last 1 year. So now the most important discussion, okay, notes to the financial statements, which are also called disclosures. Why these are very important? Because these will explain what lies behind all the numbers which are mentioned, which are there in the income statement or the balance sheet or the statement of cash flows or the statement of changes in owner's equity. So it's extremely important. And that's where the users, the analysts spend most of their time, that they look at the notes to the financial statements and that's where they extract the information. They compare it with the competitors. So what would these would have generally? Generally, corporate information, background of the company, basis of preparation, what is the financial reporting framework being followed, what is the basis of preparation, any basis of consolidation for group of companies, summary of significant accounting policies. So this is the guideline, that what are the accounting policies being implemented, being used. Significant accounting judgments, estimates, and assumptions. How have you calculated the useful life of the assets? What is the inventory valuation method? Okay. How you are calculating provisions? What are the estimates and assumptions and judgments? Okay. Business combinations and acquisition of non-controlling interest. That's where you will have, if your company has affiliates or subsidiaries, okay, not wholly owned, partially owned subsidiaries, interest in joint ventures, investments in associates, any segment information, if a company has different product lines, different geographical segments, different line of businesses, other incomes, expenses, any major adjustments to the value of the assets or to the revenues, expenses, income taxes, detail of income taxes, how the tax provisions have been calculated, how the deferred tax has been calculated, details of any discontinued operations, how earnings per share have been calculated, details of property, plant, and equipment, calculation of accumulated depreciation and calculation of depreciation, useful life of the assets. They provide you in the schedules. Details of investment properties, any intangible assets, okay, trademarks, patents, other financial assets and liabilities, detail of lease assets, lease liabilities, impairment testing of goodwill and intangibles with indefinite life. If any assets have permanent impairment, then of course how that has been calculated, any revaluation of the assets, valuation of the inventories, provisions for slow moving and inventories, slow moving and obsolete inventories, trade and other receivables, and how the provisions have been calculated for bad and doubtful debts, cash and short-term deposits, what are the constituents, the details of the bank accounts, the balances thereof. Okay, so I would like to show you basically the let me I would like to show you the financial statements of Qatar National Cement Company. Uh, can you see? Okay, can you see the financial statements of Qatar National Cement Company? Do you see the PDF document on
Yes.
screen? Okay, so see
Yes.
here, this is from the link I provided. Okay, and this includes, and I'm showing you here the audit report. The auditors are Talal Abu Ghazale. And of course, it's very important to read through the audit report because it has a lot of information. They're highlighting a lot of key audit matters, which of course, again, are quite important for investors to read through. And here, after the audit report, you will see here the balance sheet. So you see here, its balance sheet is in 2020 and 2019, comparative for 2 years. Statement of financial position as at December 31st, 2020. The assets are classified into non-current assets and current assets, right? And then total assets, and then equity and liabilities. They start with equity, share capital, legal reserve, okay, retained earnings, fair value reserve of financial assets at fair value through other comprehensive income equity instruments. Detail is provided, and this reference is reference to the notes to the financial statement. So any reader who wants detail of share capital, he will go to note number 13 and he will get the detail of share capital there. And then you see here, these are current liabilities, accounts and other payables. Detail is provided in note number 18. Borrowings, number 19, total liabilities, and both sides balance. Okay, 3,313,878 billion. So you see here, these numbers all balance. And then you go to the income statement, statement of profit and loss. Start with the revenue, cost of sales, gross profit, other income, G&A, selling and distribution expenses, share of profit or loss from associates, finance charges, profit for the year. Of course, format is slightly different. They used a slightly different format. Earnings per share, okay. So basic earnings, diluted earnings, this is, we will discuss these in another series of webinar on financial analysis. But you can see here now, this is statement of profit and loss and other comprehensive income for the, because of the timing, we did not discuss it now because that requires a little more time. And this is statement of changes in shareholders' equity, the one which I showed you in my slides as well. And then this is the statement of cash flows, again for 2 years. Cash flows from operating activities, profit for the year, adjustments, depreciation, provisions, right? Other incomes, amortization, okay, and then changes in working capital, inventories, accounts and other receivables, accounts and other payables, cash generated from operations. So this is very important, that cash generated from operations, net cash from operating activities is positive. That shows that the company is not only profitable, but it's also generating huge amount of cash from its core business activities. Now, this is very important. That is the company generating cash and profit from its core business activities, or is it generating cash from borrowings or from investments by selling its assets? Because you need cash to make payments to your suppliers, you need cash to make payments for taxation, you need cash to pay your employees, okay, and for all the expenses. These are cash flows from investing activities. These are cash flows from financing activities. And these are the numbers which reconcile directly to the balance sheet. This is the balance of cash and cash equivalents in the balance sheet. And then here you have all the notes to the financial statements. Now it's very important that as an investor, they read through notes to the financial statements. General information, application of revised international financial reporting standards, right? Summary of significant accounting policies, and you can see here different policies being explained here in a summary. Okay, So there are a lot of details in notes to the financial statements. So, okay. So generally, the companies do not change these policies frequently. They apply these policies consistently on a year-to-year basis. And that's very important, because if they change any policy, it has to be disclosed and there has to be a justification, because this will impact the not only the balance sheet, but the income statement of the company as well. Okay. Right. So do we have more time, or are we pretty
Yes,
much
sure,
covered?
sure.
Okay,
We still have time.
we still have time. So I would like to show you, we are still in the, these are still the policies. So now you see, the next note is about critical accounting judgments and key sources of estimation uncertainty. That what are the critical accounting judgments, how these are made, and what do they do about uncertainties? Okay. So see here again, explaining provisions for obsolete and slow moving inventories. What is the basis of calculating those provisions? Policy on going concern, fair value measurement, credit risk, okay, calculation of any loss allowance. So now here you can see, now this is in different layout, but this is the detail of property, plant and equipment. So property, plant and equipment is again divided into buildings, into plants and equipment, okay, into motor vehicles, furniture, fixtures, okay, capital work in progress, and of course they show the depreciation, the balances, the accumulated depreciation, the depreciation for the year, right, and then the balance at the end of previous year and balance at the end of this year. Okay, and then of course again how these have been calculated. The company's cement plant and building include certain housings are constructed on land licensed from the state of Qatar via NBD. So they provide all these details. Now, if you are looking only at the balance sheet, then you wouldn't know all the details. As an investor, especially for long-term investor or a major investor, it's important to know all these details. Then again, here's the depreciation charge for the year. Okay, how it has been calculated, estimates of changes, estimates of useful life of property, plant and equipment, and if there have been any changes. So now why there have been any changes? Of course, during the pandemic, apparently some of their plants were not operative. So they revised the estimated useful life of the asset because it depends on their number of hours which they run. Okay, so they revised it, and that's why they have to disclose it. Any major change in estimates, any major change in accounting policy, accounting method has to be properly disclosed. So you see here investment properties, detail of the investment properties, any depreciation. Okay, so together with more details that rental income from. So all these details, intangible assets, what are the intangible assets and how amortization has been calculated. So what are the intangible assets here? Cost of software development, SAP, ERP. So this is their major intangible assets, right? Investments in associates, these are associates. What is the value of the investment this year, balance at the last year, and what are the associated important details here? All have been disclosed here. Okay, so financial assets at fair value through other comprehensive. So these are the financial assets which do not impacted the income statement directly. So these will come later at some at later point in time, but for the information of the users of the financial statements, these are disclosed in full detail. And then inventories. What are the categories of the inventories? Work in progress, spare parts, raw materials, finished goods, fuel, oil and lubricants, other miscellaneous. And then of course, they have shown here provision for obsolete and slow moving inventories. And through note 10B, this is note 10A. Through note 10B, they will provide the detail of this provision. So you can see here, note B provides the how the provision, what are the movements in the provision for the slow moving and obsolete inventories. Okay, accounts and other receivables. So you can see here the balance of accounts receivable. Okay, so this is note 11A. Note 11B provides further details. Okay, concentration. So that means that three major customers, which represent 32% of total accounts receivable. So that means if one of those major customer defaults, the company will have a big loss, but they have disclosed it here, right? So that tells you concentration of the risk the company has, right? The provision for expected credit loss. This has been explained in 11C here, that what is the provision for expected loss for bad and doubtful debts. And then the policy on that as well, that how expected credit loss model has been used. Now, this is something new which has been introduced under IFRS 9. Prior to that, of course, it was always after the fact, but after implementation of IFRS 9, now you have to estimate your expected credit loss upfront at the time you make the sale. So that's one good thing which happened post 2008 financial meltdown. So cash and cash equivalents. So you see here you have detail of what constitutes cash and cash equivalents. Cash in hand, balances in call and current accounts, and short-term fixed deposits. See, maturity within 90 days. Within 90 days of their original date. So again, here note 13, share capital. What is the authorized, issued, and fully paid up capital? What are the legal reserve balances? What is the requirement of the minimum legal reserve? Fair value reserve of financial assets, right? So all these details are given in these notes to the financial statements. Accounts and other payables, right? Detail of accounts payables. Okay, accruals against energy supplies, because they are probably using a lot of energy. Accruals and provisions, dividends payable, accounts payables, which are trade payables to the suppliers. But you can see here now, they've divided it, split it, and shown all major categories of accounts payables. Now, if you look at only one number, it's very easy to assume that probably the bigger part of this 259 million will be the accounts payable, which is the trade payables. But that's not the case. It's accruals against energy supplies. Okay, one single supplier, which is probably Keherma, almost 104 million, right? So you can see here the more detail given here, the gas sale and purchase agreement, right? So it's again very important to go through the notes to the financial statements. Without that, the financial statements are incomplete. Okay, now we can go to our Q&A sessions, and please feel free to ask any questions if you may have.
Thank you very much, Mr. Abrar, for this great information and useful presentation.